It's back, baby. Inflation. Probably one of the least favorite things. There's a lot of least favorite things in the world, but definitely inflation kind of rates up pretty highly on the list of things that kind of suck. Inflation is coming back in the USA, and that is a real problem for risk assets, whether we talk about the extreme end of risk and monkey pictures, or whether we talk about more stable, sane assets like Bitcoin and tech stocks, or even index funds. Well, it's all problematic with inflation coming back up because we have to now ask, with inflation going up, of course, why is inflation going up? But with inflation going up, what's the Fed going to do, and how is it going to affect your bottom line? Well, let's talk about it. Make sure, of course, before we dive into that, leave a thumbs up on this video if you do like this kind of content, and subscribe to the channel if you're not already. So, inflation's back, guys. Inflation's back. We'll see for how long, of course, but we do see a definitive trend moving up in inflation. We saw this month a big jump up in inflation, exceeding expectations, in fact, this move in inflation. So we bottomed out a few months ago, and now we've seen surges back up. So 2 months ago, we bottomed. Now we're pumping back up 2 months in a row now of 3 months in a row, actually, of inflation increasing. Not a great sign for the markets, because as inflation goes up, regular people get the screws tightened on them just a little bit, and a little bit, and a little bit, and a little bit. Everything becomes harder to afford. And that is very, very problematic for risk markets, because when people can't afford to put food on the table to feed their kids, they can't afford to go out and make speculative investments into all the fun things that we like to invest in. And they can't even do more sane things like buying index funds or bonds or whatever, sane, rational people do. That is not me and probably not you. Those things aren't bad too. But, monkey pictures and Bitcoin, guys. Tech stocks. Yeah, that's what we want. All right, anyway. Core inflation at least has come down, and I think that's a positive sign, a trend that is moving in the right direction. At least something's moving in the right direction. So core inflation's down, and that's actually perhaps a more important sign. We have seen core inflation coming down for, about 12 months now, which is a good thing. So core inflation's down to 4.3%. So although the consumer price index has gone up, the CPI, in the last few months, core inflation does continue to trend down. So that is a very, very important thing. Now, why is inflation going back up? Well, higher energy prices boosted U.S. headline inflation in August and likely contributed to the upside surprise in core inflation. The U.S. Consumer Price Index rose 0.6%, which is a pretty big move that was in line with estimates. This comes on the heels of two consecutive 0.2% monthly gains. The CPI for energy jumped 5.6% after inching 0.1% higher in July. Within energy, the CPI for gasoline in particular surged 10.6%. Food prices were up 0.2% for the second month in a row. Excluding food and energy, the CPI was up 0.3%, which was stronger than the consensus expectations, 0.2%. Within the core CPI, used vehicle prices fell by 1.2%. New vehicle prices were up 0.3%. And higher energy prices led to a 4.9% decrease in the CPI for airline fares. A lot of it has to do with this chart right here. The price of oil is going up. In fact, oil just had a golden cross happen, a bullish crossover where we see the 50-day moving average crossing over the 200-day moving average. Now you can see the last time that happened was quite a long time ago. Quite a long time ago indeed. Last time we had a bullish crossover was in November of 2020. From that point, oil rallied from around $40 a barrel all the way up to $129, $130 a barrel before the markets cooled off in 2022. That's pretty interesting. Food for thought there. Now, there's no knowing how crazy this particular rally is going to be, but we must remember there have been big supply cuts from some major players here, including Saudi Arabia and including Russia, who are two of the biggest producers globally. Now, can other producers step in to fill in that gap in demand? Perhaps. But then Saudi Arabia and Russia can just cut more So there's a definite price war going on here with oil. Saudi Arabia and Russia are leading that charge. It all makes sense if you really think about it. Why would they want to sell their oil for cheaper when they can keep more of it in the ground? It's like a bank account in the ground for them, and they just draw out a little bit when they want and sell it to you for higher prices instead of, doing a favor to everybody and ripping tons of oil out and selling it for super cheap and flooding the markets. They don't necessarily want that. Then we'll get more for their oil. And that's exactly what they're damn well doing. Peter Schiff coming out here saying today oil hit $90, up more than 40% over the past 4 months. A 10% monthly rise in the oil price hardly seems like disinflation. Unless the Fed hikes rates far higher than expectations or Biden empties every last drop of oil from the SPR, oil could hit $150 by election day. Big words from Peter Schiff here, of course. Is he going to be right? I mean, Peter Schiff's been wrong on a lot of things a lot of times, but he does make good points. This all creates real problems for the Federal Reserve because as oil prices rise, it creates more inflation, and they're trying to get inflation down. If they can't get inflation down, they either have to keep the rates higher for longer or they have to hike rates even higher than they had previously signaled. Both are problematic for markets, particularly if they actually go with higher rates. Now, if they kind of plateau here, not amazing for markets. It does create a lot of problems. However, manageable. The other factor here is President Biden. He's been draining the strategic petroleum reserve to try and keep the prices of oil down, but there's only so much oil that he can drain. And unless he drains every last drop of that, which is a strategic mistake because it's supposed to be strategic petroleum reserve, not just a, hey, we'd like to keep the price of oil low reserve. We run the risk of seeing oil prices going higher. In that situation, it creates more inflationary pressure, which creates more problems for the Fed. Now, before we break this down a little bit further for you, I just wanted to give you a quick note that if you are not yet signed up to the Wealth Mastery newsletter, you got to get it checked out. It's the best damn newsletter in the cryptocurrency industry. Every single issue massively packed full of value for you, the reader. We send it to your inbox 3 times per week. The latest on crypto, the latest on altcoin alpha, technical analysis, DeFi, airdrops, NFTs, and more. If you don't have it, you're missing out. Use the link in the description to get signed up for free and join our 75,000 weekly readers. Thank you. Now, interestingly, I'd like to point out here, even though inflation is up, and that is worrying for a variety of reasons, market's doing okay. S&P 500, it's up this week. Cool. I guess that's sweet. Although Citadel's Ken Griffin is unsure the stock market rally can continue. He is worried. He says, I'm a bit anxious this rally can continue. I like to believe that this rally has legs, but I'm a bit anxious. We're sort of in the 7th or 8th inning of this rally, but part of it has been the soft landing story. Will we get the soft landing? Will the Fed be forced to crash the economy to bring inflation back down? It is their key goal, must lower inflation. And what are they willing to do that? Look, inflation, it's a sticky problem for a variety of reasons, and soaring oil prices can unwind things real fast. Remember, a year ago, inflation was, the CPI rate was at 8.3%. And that went down, month after month after month, all the way until June, where we hit 3%. Came back up to 3.7% now. So very, very problematic seeing these kind of numbers. And if the price of oil keeps going up, that puts more pressure on inflation. Now, right now, interestingly, today's CPI reading, or yesterday's, or maybe 2 days ago, it makes the probability of a rate hike on September 20th, where the next Federal Reserve meeting happens, basically it doesn't do anything to lower or raise that expectation. There's still 97% of the market still believes that the Federal Reserve is not going to raise interest rates at their next meeting, that they've raised far enough already and they need to let things play out a little bit. Even though we see that CPI coming back up, core inflation is going down, which is something they're going to be watching. So this short-term CPI bump could just be something, well, we're going to watch the oil markets, we're going to see what happens. Maybe it's not that big of a deal. Maybe we don't need to push rate hikes up even more. Key things to watch here. So according to Forbes. The key data to watch will be the inflation reports. Within these numbers, the Fed is looking for services prices to cool and for housing prices to moderate. Energy prices are generally increasing at the moment, which could drive up headline inflation numbers further. But so far, the Fed may be willing to look through more volatile energy prices. So that means the Fed may not be looking at the energy prices as the core thing that's worrying for them. They want other stuff to come down. If the other stuff comes down, maybe energy is not going to be such a big deal short term. Long term, energy prices have a big impact because everything requires energy. The food you buy in your store, it had to be harvested using energy, grown using energy, brought to store using energy, cooled in the store using energy, sold to you using energy, cooked using energy, disposed of using energy. That's all got a big impact. They go on. Unemployment data will be important too. So we have seen unemployment spiking in the last month. That might actually be a good thing for the Fed. Now, the Fed currently believes the labor market was running fairly hot since 2021, so some degree of moderation will be well received by policymakers as a way to help cool inflation. So more people losing their jobs to the Fed is a good thing, and that has been what is happening recently. But they don't want to do it so much that we tip the U.S. economy into a recession. They want that soft landing. They want to cool things down without completely crashing the economy. Much easier said than done, by the way. What to expect? We're likely very close to the top of this interest rate cycle. However, if upcoming economic data doesn't provide reassurance to the Fed that inflation is coming back to its 2% goal, then the Fed may start to hint at another 2023 interest rate increase, probably in November. That may be the last one of this cycle, or maybe the final increase already happened in July if coming economic data is more favorable. So this is the problem with inflation going up. What's the Fed going to do? Are they going to raise rates more? Are they just going to keep them higher for longer? And all that has a big impact because as oil prices go up, it makes it harder for businesses. Once again, prices have to go up, which means everything starts becoming problematic. And those high interest rates, we have hundreds of billions of dollars of corporate refinancing happening over the next few months. That's going to happen at a higher interest rate, meaning that a lot of companies are suddenly going to find themselves very, very deep in the crap because they're not going to have the money to pay that refinancing, especially as sales slow because inflation is up. People can afford to buy less stuff. Everyone doesn't have a bunch of extra money from making money on dog coins and monkey pictures. These are problems. These are problems in the economy right now. And as investors, we've got to know about these things. We have to know about the risks that are happening in the economy and the extent to which those risks can cause further problems for our investments and at the end of the day, for our bottom line. I hope you enjoyed the video. I'll see you in the next one.